If the news about the stock market rising and falling, rents climbing back up, student loan debt ballooning, and the rising health insurance premiums are making your head spin, we hear you. Managing your own finances can be a convoluting and daunting endeavor, but it's important to start as soon as possible if you plan on owning a home, investing back into the stock market, or retiring, no matter how far in the future that may be. Hi, I'm Mackenzie, and welcome back to the channel where we give you expert tips on growing your wealth and saving your money. Today, I'm going to give you the 7 best tips for managing your money right now so that you can face any catastrophe that might come your way. Well, not now. Wait until you finish the video. And as we go through these steps, please bear in mind that I am not a financial advisor, so I encourage you to do your own research and due diligence before you place any trades or make any financial decisions. If there is one tip I want you to promise me you'll use, it's to create a monthly budget. This comes down to the basic philosophy of what gets measured gets managed. Generally, the feeling of stress happens when you feel like you're not in control. Creating a monthly budget and sticking to it will be empowering for you. The steps to making one are so simple. You can even find an outline to a sample budget on the FTC's website. We've put the link in the description box below. First up, add up all of your monthly income. This includes your income from your day job as well as any side hustles or side gigs you might have. If your job includes any bonuses on certain months or you get a tax refund, be sure to include those on the months where it's relevant. Then add up all of your expenses. Start with the ones that are consistent every month. So things like your rent, your mortgage payments, your groceries, transportation, your phone, your internet, utilities. For expenses that can vary month to month, so for example, entertainment, eating out, shopping, do your best to average these out. You can also add in any specific amounts that you want to set aside and save each month. And then finally, subtract your monthly expenses from your income. This will give you your leftover amount. You want to put this money towards things like paying down debt, putting money towards savings and investments to watching them grow over time, or putting them into a retirement fund. Having a plan like this down on paper will remove any sort of doubt or confusion as to how much money you have to spend, and it will stop you from spending money that you don't have. Tip number 2, start an emergency fund. Having an emergency fund will help you pay for unexpected expenses, so your car breaks down, or for when you're in a financial pinch, for example, you lose your job. This gives you greater peace of mind. After you've set a monthly budget, you'll know how much you can put into savings each month. Start putting those funds towards an emergency fund. Experts suggest setting aside at least 3 to 6 months of living expenses if you can. If you can, you'll want to stash away your emergency fund into a high-yield savings account. That way, any interest you earn will compound and make your emergency fund bigger than it was when you put it in. Keep in mind that online banks typically offer more favorable interest rates than traditional banks. You can check out our page where we compare the high-interest savings accounts that can earn you up to 12% in interest. The link is in the description bar below. Here are a few extra tips for growing your emergency fund faster. First, set up regular direct deposits to your savings account. Put cash gifts and work bonuses into your savings account. And 3, take on an extra side gig if your schedule allows it. My next tip, build your credit. If you haven't built much credit history yet, a simple fix is to use a credit card for as much as you can over cash or a debit card. Think things like grocery shopping, your morning coffee, streaming subscriptions, you get the idea. To get started, you want to open up a credit card with a decent spending limit and make sure you pay it off each month. This way, you'll avoid paying any interest. We have a guide to picking the best credit cards for your spending needs and interests. I've linked it in the description box below. If you're not sure what you qualify for, start with a secured credit card. These are kind of like debit cards in the sense that you need to deposit a certain amount of money as collateral in case you aren't able to pay off your balance each month. But with time and responsible spending, you can build up your credit so that you can have access to cards with higher spending limits, better interest rates, and perks. Tip number 4, make a plan to pay off any debts that you might have. No matter how mindful you are, sometimes unforeseen circumstances mean that you end up racking up more expenses than you have the cash to pay for. Know that there are strategies that you can use to pay down your debt, gain more control, and give you peace of mind. The 2 most common ways to pay off your debt are the avalanche method and the snowball method. For the snowball method, you just need to make the minimum payments towards your debt so that you don't incur any extra interest or late fees. Then, you use any money left over from your monthly budget to pay off your smallest debt. Then you use any money left over from that to pay off your second smallest debt, then your third smallest debt, and so on. For the avalanche method, you start by listing your debts based on interest rate, from the highest to the lowest. You'll then pay off the balance with the highest interest rate first. Once that's paid off, any extra money will be put towards paying off the next debt on your list. And so on and so forth, you slowly tackle your debt like an avalanche. The snowball method focuses on paying off your smallest debt first. This method is good for people with tighter budgets who have less income each month to dedicate towards paying off debt. However, debts with higher interest rates may take longer to pay off, which will cost you more in the long run. By contrast, the avalanche method focuses on tackling the biggest balance first. So this is better for people with bigger monthly budgets. The main benefit of the avalanche method is that you'll pay less in the long run because you'll spend less money in interest. Tip number 5, start saving for retirement. Saving for retirement early is one of the best things you can do to secure your financial future. With the power of compound interest or compound dividends, that is, earning interest on the interest that you've already earned or earning dividends on the dividends you've already earned, you can grow your money faster over time. Let's look at 2 different examples. First, Maria. Maria is 20 years old. She starts saving $120 each month in a mutual fund that earns about 12% annually. By the time she's 60 years old, her $120 investment per month is going to be worth a whopping $1,440,730. Dave is 35 years old. He also starts investing $120 a month into a mutual fund with a 12% yield, but he starts 15 years later than Maria. By the time Dave is 60, his investment will be worth $1.2 million less than Maria's. As you can see, starting your retirement savings early and taking advantage of the power of compound interest means you'll have more money later in life. Tip number 6, put any extra or bonus cash that you have into savings or investments. Say some extra cash comes your way. While it might be tempting to run out and buy some new shoes or get the latest iPhone, you might want to consider putting that money away into savings or investments. While short-term purchases can make you feel good for a time, I promise you that there is nothing more exciting than watching your money multiply before your eyes. Scientists say that it takes only 21 days to form a new habit. Try to resist the urge to splurge on your meal out and cook dinner instead at home, or say goodbye to your daily Starbucks latte and make it a treat instead, brewing your own coffee at home each day. That will leave you more money to save for an emergency, pay off your debt, put money into an investment account or retirement account. And in no time, that decision making will be second nature for you. And finally, make sure to create separate financial goals for the long term and the short term. Setting financial goals can be fun. Whether or not they're short term or long term depends on their purpose. Short term goals are best for a timeline of 5 years or less. So these are things like saving up to buy a new car, paying down your student debt, or saving up for a down payment on your home. Short-term goals are best for timelines of 5 years or less. So these are things like paying down your student debt, saving up for a new car, or saving up for a down payment. Long-term goals are best for a timeline of more than 5 years. These are things like paying off your mortgage, paying off your student loans, or saving for retirement. Write down your financial goals and identify what you want to do with your hard-earned cash. That's what's going to motivate you to make smart money decisions. Thanks again for watching, and make sure to like this video, subscribe, and hit the bell button below so that you don't miss any of our videos. Are there any tips I missed? If so, leave them in the comments below. Thanks for watching, and I'll see you next time.